In this recording, we're going to look at how to analyze financial statements. So let's start with ourselves. How do you know whether you're performing well as a student or not? What information tells you that? Well, first off, that's what grades are for, right? Tells you how well, you're doing A work, B work, C, D, F, whatever. But also, you may look to your peers. Your friends or others in the class, how well are they doing? Because if most students are getting a C and you're earning a C, you may be content with that. But if most students are earning an A and you're earning a C, you may not be as content with it. And then your instructor may, in addition to grades, your instructor may give you additional feedback, such as when you write a paper, feedback, or Excel spreadsheets, anything that you turn in, the instructor feedback. And then perhaps just your life situation as well. What's going on in your life? Do you have a lot of other things going on besides school? If you do, then you may be content with the C in class instead of the A because you know, given your life situation, this is as good as it can get, not just for you, but perhaps just anybody in your situation. So all of these are mechanisms for feedback that you take into consideration whether you decide whether you're content with your performance. Well, that's what really we want to look at as an accountant. We provide much of the information for management's performance, which is actually the company's performance as well, isn't it? So the financial statements are a good tool for providing feedback. So before we look at some of that, I want to review. We really looked at this with the statement of cash flow, but this really is a picture of business, right? When the business gets started, choosing between debt and or equity financing, that money that comes in is invested in assets, right? Physical assets, or can be intangible as well. Those assets are then used to generate sales revenue. And that will result in, after we net out the expenses, of net income, hopefully. And if we do have profits, that will satisfy our investors and creditors. So just reviewing that, because this big picture is really what we want to analyze. We want to analyze the method of financing. We want to analyze the kinds of assets, and then how efficient and effective are our assets. How effective are our assets generating revenues? And then what about sales in relationship to profits, and how happy are our investors and creditors going to be? So that's really the big picture of analysis. All right, so who's using financial statement analysis? Well, short-term creditors look at the ability of the company to pay maturing obligations. So they're very much interested in short-term liquidity, how quickly those assets can be converted to cash. Bondholders, those are long-term debt. So they're looking at the long-term, the capital structure. They're concerned with past earnings. They're concerned with projected future earnings. They're also concerned about the financial position of the company, meaning the balance sheet. How are the assets financed, mostly debt or equity? Stockholders are also viewed as long-term investors. So they're focused on long-term prospects generally, although they may be buying our stock just for the short run. But thinking of them as long-term, they're looking at the stability of those future earnings. So they're looking at a lot of the same features as the long-term creditors, but they also are very, very focused on earnings, because future earnings enable future dividends or distributions of those earnings. Management focuses on the composition of the capital structure, changes in trends in earnings, and all of that directly influences how capital projects will be financed, right, with debt or equity. And then the accountant's role, our role is to measure these economic events and communicate them. But in order to do that, we have to understand what we're measuring. So it does presume not only do we prepare the statements, but we interpret the results as well. So we have to understand how to analyze the financial statements in order to make those communications. Here's the typical kinds of ratios, and we break them out into categories. Chapter 24 of your book really lists the first four. I want to stop for just a sec, and I want to refer to that as well. So I want to point out in Chapter 5 of your textbook, it lists various ratios, it gives you the formula, and it'll tell you how they're used. So I encourage you, actually, there should be a PDF of this available for you in the online course, but you certainly can go to Chapter 5 of your textbook and get this for yourself. Also, Chapter 24 does something rather similar. Interesting enough, Chapter 24 has fewer ratios, but again, notice they're going to be in the categories liquidity, activity, profitability, and coverage. That's how you're going to be focusing on your financial statement analysis project that you'll be completing. Here it gives the ratio, the formula, but even more importantly, this is very good, it's going to refer you back to certain pages. I strongly encourage you to go back to these pages and read about each of the ratios because you need to have a very good understanding of each of those going forward. Okay, so here's the different kinds of ratios and what they're measuring. And so what we'll tend to do is we're going to look at the company and compare itself over time, what's going on maybe in the last 3 years. And ideally, we would also compare the company with how are others in the industry doing. Just like you do with your peers. As a student, companies do the same thing. They're going to look at their peers. But be a little careful because if you get those industry averages, what's kind of normal for the industry, you also have to ask yourself, is the industry healthy? Because an industry that is not healthy will have weak ratios. So you don't want to think that those ratios are always the ideal. It could be, again, that the industry is just a very healthy, thriving industry, and so that is the ideal. But if the industry in general is suffering, then you don't want to think of that as when I'm comparing the company's ratios to the industry, then I'm comparing with the ideal, because it certainly wouldn't be. Okay, what questions do we need to be asking ourselves as we analyze a company financially? Well, kind of have to know questions to ask. And to a certain extent, you're going to find it's a puzzle. Some of these questions will just come to you as you start solving pieces of the puzzle. We want to recognize the ratios and what do the comparisons tell us. So the ratios are a good place to get started, but I also have to understand what are the ratios telling me. And then match the question in Part A with the appropriate analytical tool. So if I want to know about liquidity, then I want to recognize, well, what ratios are going to tell me about liquidity? So I need to match those together. Okay, so I'm really going to look at the numbers and the interpretation. In the homework, you've had plenty of, either you have or you will have, plenty of opportunity to do the calculations for the ratios and that sort of thing. But usually what the hard part is not the calculations, it's the interpretation. And that's what I want to go over today. So I want to point out that in the course, you also will have in an Excel spreadsheet the financial statements for this company where I calculated these ratios. And let me show you that here real quick. So I wanted to show you, here's the income statement. And you can go on down, scroll on down, you'll see the balance sheet and etc. And then I did the ratios. But I want you to see how you could set up the income statement and balance sheet. Notice I have formulas. I didn't do this by hand. I used Excel to calculate the ratios. So just kind of showing you how you don't have to set up your project this way, but this would be one way of setting it up. So, here are the income statement and balance sheet. Then I copied the income statement over, so I copied this spreadsheet over to here and set it up a little different. But here's the income statement, and here's my horizontal analysis, so that I look at the difference from 2013 to 2014. It went up, and then what percentage did it go up? And again, you can see those are all formulas. And then I did the same thing for the balance sheet, the vertical analysis. And so you can see, net sales is always the base for that at 100%. So anyhow, I just want to bring your attention to that, and so that you have that as a resource. So I have listed out the current ratio, which is current assets divided by current liability, and it's going to measure the coverage of the short-term or current liabilities or debt. So here's 2013. We can see it went up in 2014 and then up even more in 2015. So we have, the trend is that it's going up, and usually I would think that's a very good sort of thing. But the rule of thumb, is a 2-to-1 ratio is ideal. So 2-to-1. In this case, there really isn't it's way above that. Instead of, I can't get that to write very well. So instead of 2-to-1, we have like 5.5 to 1, 5.5 to 1, 4.1 to 1. So, like in 2015, for every dollar of current liability, there's $5.50 of current assets. And that's pretty high. So, usually the concern is that it's too low. So, it might be for every $1 current liability, like there's $1.25 of current asset. And ideally, it's 1 to 2, $2 of current assets for every $1 current liability. So in this current case, I would actually say, it sounds healthy, but it's probably not a good thing, meaning that they have excess current assets in relationship to their current liabilities. So unless they have a lot of long-term debt coming, well, it shouldn't be. If it was coming maturing fairly soon, it should be in the current assets. So, we would probably make a recommendation, or you want to make a recommendation to convert some of those current assets into investments that can generate a higher rate of return than a current asset has the opportunity to do. Okay, now a better measure of coverage for the short-term debt is the quick assets, because it's really going to look at those assets, those short-term assets that really are convertible to cash. So cash, marketable securities, and receivables. In other words, it's not going to, it does not include prepaid expenses, right? Prepaid expenses, like prepaid rent, prepaid insurance, often are current assets, but they don't really cover and help pay current liabilities. So that's going to, remove prepaid expense from that. And also inventory. Inventory depends. It can be a quick asset. If it was a grocery store, it would be a quick asset because their inventory sells within a few days. But if it was, most retailers, it's not. For other retailers, it's usually, like for a grocery store, I think, their inventory often will sell within, 3 days. But for most other retailers, it can be, couple of weeks, well, or even longer. It can be, like 6-8 weeks before it actually, on average, sells. Okay, so what do we got going on here? Also, we have an upward trend, but we can see it's not as big, is it? So that kind of tells me if we were to go look at this company's current assets, they have a lot of non-quick assets. So, so really, this is this asset test ratio is such a better measure. It's telling us of the current assets that are really available to cover short-term debt. It's like for every $1 current liability, there's $2.30. Now that seems more normal and more reasonable. And it gets back to this when I said, well, they should take some of that out and invest it. Well, if it's prepaid expenses, that's not something they'd be able to do, would they? Because those are just invested in the rent. Second category of ratios we'll look at are the activity ratios. And this is going to tell us about, things like accounts receivable, and inventory, and even just total assets in general. So the first one, receivables turnover. That's taking our net credit sales, dividing by our average accounts receivable. And by the way, ideally you want to use the average accounts receivable or the average on all of these formulas. However, I will tell you, because I wanted to get 3 years for this demonstration, I just used ending balances. So when you see my Excel spreadsheets, you'll see that I just divided by the ending and I didn't solve for an average. So you just use what you can have. If you're not able to get, I wanted to have 3 years, and in order to do that, I had to just let the ending balances suffice. Okay, so here we can see from 2013 to 2015, we're on a downward trend. Well, why would that be happening? Why is the number getting smaller? That's because, right, the accounts receivable has to be growing at a faster rate than sales. Just quantitatively, that's what's going on. Well, why would accounts receivable be growing faster than sales? Well, that's hard to say. But it could be, that we might have some bad accounts that need to be written off. So are there any bad accounts receivable that need to be written off? That would be one thing I might look at. So it might just be something accounting related. Or it could be that they're stockpiling their accounts receivable and they're not being aggressive with getting out there and collecting from their customers. Now, most analysts prefer to take the receivable and turn it into days. For instance, if something happens 36 times during the year, well, how many days on average would that be? Well, I would just divide the 36 into 365 days, and I would get 10 days. So we can see in 2015, on average, it took them 10 days to collect, where in 2013, it only took them 7.5 days. So here again, it looks like it's taking longer to collect. It could be that that's why it truly is taking them longer to collect, or it could be they just have some bad accounts they need to write off. Okay, next one, inventory turnover. That's taking our cost of goods sold, dividing by our average inventory, and in my case, I used ending. Here again, we see, this is going down. If it's going down, that's because the denominator is growing at a faster rate than the numerator. Well, why would inventory be growing? Well, it looks like, they're just not selling it as fast. If we take this number and divide it into 365, we can see they've gone from roughly 40 days to selling it to 57. Wow, that's a big jump. Why is it taking longer to sell their inventory? Don't know, but that is something management really needs to get a handle on. The business is growing. Why is inventory growing at a faster rate than cost of goods sold? That definitely is something management would want to get a hold on. Now, a couple of things I want to point out. I want to point out that the costing method will make a difference. So there's some accounting issues with inventory that will make a difference. For instance, let's say that this company uses LIFO for inventory. If they use LIFO for costing their inventory, that's first in, first out. So cost of goods sold, right, is going to be first in, or the first out items, first in, first out, sorry about that. So the last units purchased are the first ones sold. That's the assumption. We don't really sell that way, but that's the cost flow assumption. So those are going to be high in periods of inflation. Those are higher price dollar amounts. So cost of goods sold gets assigned recent costs, which are higher. Inventory gets assigned older costs, right? We assume those older goods are still in ending inventory, and those will have a lower number. So if a company uses LIFO, just naturally we would expect its inventory turnover to be higher than other companies that don't use LIFO. So again, the inventory costing method can influence this. So if we were comparing with other companies. Okay, and then also, although this is going down, if this ratio had been high, a really high number, again, this company doesn't have this, but if it had been growing and was getting very, very large, and if it was getting very large, then the average days to sell, those average days to sell would be very small. It doesn't take long to sell it. So if it's not taking very long to sell, then you run the risk of what we'll call stock out costs, meaning that they may be selling it and then the shelves are just empty for a while. So we want to be careful of stock out costs if it were the opposite situation. Okay, and then accounts payable turnover, that's just taking our cost of goods sold, dividing by our accounts payable. Here we can see it kind of went up and then it went down. It went up some and then it went down even more than what it started at. So we've got these fluctuations that actually even ended up an overall increase in the average days on accounts payable. And then the other interesting thing is, the operating cycle. So how long, here's how long it took to, we'll start here. Here's how many days it took to sell the goods. Here's how many days it took to collect our money. And then, roughly here's how long it took it to pay. So we could add those together. There are some flaws in that, and I will admit. But if we added all those together, I'll get roughly 85 days. And so we are seeing, an increase. And again, the big culprits here are it's taking longer to sell it, it's taking longer to collect it, and that's increasing our overall operating cycle. So just issues with that. Okay, and then the last one is asset turnover, and here we're looking at sales in relationship to total assets. And we can see that it's gone down somewhat. And that's really not a good thing. We would really hope for that to actually be growing because it means that, our total assets are investment and we use those assets to generate sales. So we're really wanting a bigger turnover than that. And so it looks like, if I were to write a conclusion here, this company is using its assets less efficiently in 2015 than it did in 2013. So there seems to be, it's not much, it's a very slight trend down, but it does look like they're not using their assets as efficiently as they did in 2013. Now, here's a heads up on this ratio. This ratio looks at total assets, which are measured using book value. Well, book value, especially for those physical assets, is costless accumulated depreciation. So there, if you've got older assets, meaning those property, plant, and equipment, you're going to have a smaller book value. And a smaller book value lends to a higher return asset turnover. A higher asset turnover. So you want to be careful that the accounting isn't just manipulating this ratio. It could be if you had an asset turnover ratio that was going up, which is not our case, but if it was going up, it's possible just because of the accounting. We're using book value here, and we got old assets on the books. Old assets have smaller book value, causing this ratio to normally just be high, just because of the accounting for the assets. Okay, next category is profitability ratio. So this is going to look at, obviously, profits, and we're going to look at different bases like sales and total assets. So profit margin on sales, our profit is net income, so net income is our profit, and we want to look at that in relationship to sales. So we can see that's going up. That's good, right? So it tells us the company is doing a better job controlling its costs. So it's improving. It's better controlling its costs in 2015 than it did in 2013. But here's the question. What costs are we talking about? So with this ratio, I can conclude it's doing a better job, but if you look at the income statement, there's cost of goods sold, which is our product cost. There's operating expenses, our operating costs. We have, I missed one. Non-operating items, that's usually interest expense, gets categorized there. And then also income tax expense. So we kind of have 4 different kinds of costs that are on the income statement, and I haven't even factored in, I just did a basic income statement. This isn't showing discontinued operations and extraordinary items, which can be on the income statement as well. So we really would want to look at what's going on with these. So in order to do that, when you're analyzing this ratio, we want to go and look at our trend analysis for the income statement. So let's go do that. Okay, so here's our vertical income statement. So I'm going to go put these numbers down, but let's look at this percentages. So cost of goods sold is 61% of sales. It had been 63 and 64. I'm also going to add up all of these, the 39 and the 11, Excuse me, not the 39, that's gross profit. Let's add up these two. The selling and administrative expenses, those will add up to 26.6%, and then those and those. And so what I want you to see is I'm just taking, these are a percent of net sales. So 61, roughly 26.6, interest is 1%, and then income tax expense is 3.4. And all I'm going to do is take these percentages and then go put them in our notes real quick. Okay, so now I'm back and I've listed out cost of goods sold, which get categorized, that's really our product costs. It's actually gone down from 64, 63 to 61. So they are being very, they have really controlled that. So they are controlling their product costs. Usually we don't see that. Usually you see cost of goods sold, just if sales go up, cost of goods sold up goes the same amount. And so they've actually had some very good efficiency with controlling their product costs. Their operating expenses, though, they went down a little bit, but it's gone up. So here's going to be, some of the inefficiency. This is really going to be probably the culprit here. They're not controlling, we can see it's gone from 25 to almost 27%. So they're having inefficiencies with their operating expenses. Interest expense has stayed pretty flat. That would be very much connected with their debt anyhow. And tax expense, it's gone up slightly, and that's probably going to be because profits are going up as well. So here again, what costs? The main culprit here are their operating costs. So I want to point out, you're going to get a big picture with your profit margin percentage, but you have to go to that income statement and looking at the trend analysis to really narrow that down. But what cost is being controlled? Why is net income, why did it grow at a faster rate than sales? What grew at a faster rate than sales? Because they very much have controlled their cost of goods sold. They've very much been controlling their cost of goods sold, their product costs, but they haven't been controlling their operating expenses. So they could have had even more growth in this profit margin had they been controlling their operating expenses. So again, let me just say in conclusion, this profit margin has gone up. That's very good. It is mostly going up because they are controlling their product costs via cost of goods sold. However, they could have had even higher increases, even larger increases in this profit margin had they better controlled their operating expenses. Okay, next one, return on assets. Well, return on assets is another measure of profitability. So we can go through and that's just taking net income dividing by total assets. So we've got it going up. That's because the numerator is growing at a faster rate than the denominator. So that's a good thing. But there's usually two reasons for a return on asset to go up. It could be controlling cost, or it might be efficient use of assets. Well, how did we come up with this? Well, if you think about it, return on assets is actually taking our profit margin, right, this ratio right here, times our asset turnover, which was this ratio up here. And if you look at the formulas, profit margin is taking net income divided by sales, or the asset turnover is taking sales divided by total assets. Well, if you multiply those together, sales cancel out and you'll have net income divided by total assets. So it's really helpful then if I think of return on assets as having these two components, profit margin and asset turnover. Because going up here, we can see they have not been controlling their cost, meaning they have not been efficient with their use of assets. As a matter of fact, that went down. So then what's causing return on assets to go up? It's because they have good cost control. They are controlling their expenses. They are controlling expenses, and very specifically, they're controlling cost of goods sold. So again, return on assets is not going up because of the assets, it's going up because of net income and controlling those expenses, and specifically, cost of goods sold. Okay, next one. Another profitability ratio is return on stockholders' equity. And again, we're just going to take net income. Let's do that over here, net income. But we want to subtract out any dividends, declare preferred dividends, so preferred stock dividends. And then we're going to divide by our average stockholders' equity. And again, this is really looking at return for the common shareholder. That's why we take out the preferred stock dividend. Okay, and this is a very narrow view because back over here, return on assets, we're looking at the return for, if you think about it, for a business, the return is profit, so net income. That's your return on the business. Here we looked at the huge vision, all of the assets being used to generate profits. Over here, return on stockholders' equity is very narrow, looking at only from the owner's investment. Okay, so we can see when we did that, it's going up just a little bit. And so we kind of want to wonder, well, why is it going up? Well, there's a couple of things that influence this ratio. One is the extent of financial leverage. Financial leverage is, looking at, what percentage of the assets are financed with debt. So I'm going to look at debt to total assets. Now we have that ratio. It's going to be on the next page. Debt to total assets. So 18.8, all of this. So I'm going to go put these here. 18.8%, 20.5%, and 22.2%. Okay, so we're going to see some odd things. Total assets. Didn't get that all out there, did I? So debt to total assets. I still didn't get that written very nice. Okay, that looks better, doesn't it? Okay, we actually have some odd things going on here. We have return on investment, return on stockholders' equity going up. Usually we'll see that's accompanied with an increase in debt to total assets, and that's not the case here. So that's a little unusual. So let's look at why I say if this goes up, usually I'll see debt to assets go up. So let's kind of list out, actually, let me put it down at the bottom. I have a little more room, and I'm not going to talk about the payout ratio very much anyhow. So let me go down here. So assets equal liabilities plus stockholders' equity. So let's say that we had $100 of assets, and we have financed those $25 with debt, which means $75 is financed with stockholders' equity. Now let's say that we had net income of $5. So that would give us a return on equity of 5 divided by 75 would be a return on equity of 6.7%. Now, let's go back and do a what if. What if those $100 were financed more heavily with debt? So let's make it 50 instead of 25, and that means then only 50 is financed with stockholders' equity. So we'll have a smaller base here. So if we assume the same $5 net income, but again, we're going to have, for the investor's view, for the investor's eyesight or their view, there's a smaller base of $5, then the return to the owner's equity is 10%, and it goes up. So that's why I say, usually if return on equity goes up, that's because we have a larger debt financing, and those go hand in hand. And that's part of the concept of financial leverage. Concept of financial leverage. We finance more heavily with debt, even though, in spite of it carrying more risk, but it generates a higher return to our investors. Not necessarily return, our return on assets, but it will generate a higher return on equity. Okay, so that's what I would expect. If this went up, that went up. So this is odd because that actually went down. So it went up, so clearly leverage, this company is not using financial leverage to cause this an increase. And again, it's a slight increase. So I would conclude really this went up because profits went up. So really what contributed to this increase in return on stockholders' equity, the extra large profits in 2015 were influential. It was not caused by financial leverage, which is normally the case. Okay, another ratio, earnings per share, net income less our preferred dividends divided by, so subtract our preferred stock dividends, and we're going to divide by our number of common shares outstanding. So we can see that's going up. And again, that's probably because net income increased year after year, so I'd expect earnings per share to go up. We do want to caution you when you're looking at companies' earnings per share, it can be easily manipulated. By buying treasury stock. Whoop, misspelled that. Okay, so fix that. So if they buy treasury stock, that's going to shrink the number of shares outstanding and cause this ratio to go up. So you do want to be careful that that's not what's going on, and it was not in this particular case. Price earnings, payout ratio, those are pretty self-explanatory. I'm not really going to lecture over those. All right, last ones. Coverage ratios. We've already talked about total debt to total assets. Also, that means stockholders' equity, then to total assets would be the opposite. So if this is 18.8, this is going to be 81.2. So, because they've got a total 100%, 79.5, and 77.8. And I point that out because if you're looking at debt to total assets, then you also have to be thinking about stockholders' equity to total assets. Times interest earned, this isn't really, measures the ability to pay interest as it comes due. You're looking at income before interest and before income taxes, and divide by your interest expense. So we can see that's growing. That's a good, that's good. We have more strength, more profit. There's really your coverage of your interest. So we've got more profit covering our interest charges. So that's a good thing. Book value per share, common stock, stockholders' equity to outstanding shares. The big flaw here is it's using book value. So even though this is going up, and that looks healthy, but the reality is that book value isn't very relevant. Market value of those assets would have been much more relevant and useful to, so if you had market value per share, that would be much more relevant. This is looking at book value of those net assets. So it's kind of meaningful, but again, it's not as meaningful as if we had used market value. Okay, and then lastly, let's look at some of the limitations of these ratios. So, certainly there's great benefit of using the ratio analysis, but you do have to exercise some caution because there's some flaws to it. The financial statements report the past. There is a critical assumption then that the past is a way of forecasting the future. That may or may not be an accurate assumption. So we're looking at what happened in the past. The question is that a good predictor of the future? And there could be economic trends going on that would lend you to say, no, this is not going to predict what's going to happen in the future. Also, we use historical cost. Again, that's not market value. That's not as relevant as market value. Use of alternative accounting methods. For instance, the LIFO instead of FIFO. On that inventory turnover distorts comparability among companies. So if you've got a company using LIFO and you're comparing it with a company using FIFO, just because of the inventory method, you should anticipate differences just because of the accounting. Also, accounting uses estimates and different accounting principles that will compare consistency among accounting periods. Okay, trend analysis may serve as a red flag for more in-depth analysis to determine the cause. So just like we saw with the profit margin, actually that we saw not so much a red flag, a negative red flag. We saw a flag of something good happening, but we had to do more in-depth analysis to determine what was the cause of causing the profit margin to go up. A single ratio usually doesn't stand alone, so you want to look at ratios together in clusters like the coverage ratios, the profitability ratios. Look at them collectively instead of separately. Comparisons among companies can be difficult just because of different sizes of companies, that alone. Do you compare a really large company with a small company? Well, you can, but you want to take that into, factor that in, that a small company is going to have different economies of scale than a large company. Okay, and also not all analysts use the same formulas. So your textbook will have a formula. Even when you go to your financial management book, it may have the same formula, have the same ratio, but it may have a slightly different formula. So just heads up, not all analysts use the exact same formula for each of these ratios.